Welcome to today's Explainer. I'm going to be your financial mentor today. And look, we're skipping the usual pleasantries because we've got a massive illusion to shatter right off the bat. For decades, Wall Street has sold us this idea that building wealth requires absolute financial genius, right? Like you need to deeply analyze balance sheets and somehow predict the future. Well, today we're going to demystify how real sustainable wealth is actually built. And I promise you, it is so much simpler than the financial industry wants you to believe. Let's kick things off with a pretty wild question. I want you to think about this for a second. Why is it that 90% of professional Wall Street fund managers, people armed with Ivy League degrees, massive research teams, and literal supercomputers, statistically fail to beat a simple, unmanaged, absolutely boring basket of stocks over the long run? I mean, it sounds totally impossible, right? How can the absolute experts lose to a strategy that essentially does nothing?
Well, the answer really lies in how we're conditioned to view investing. As everyday investors, we are constantly bombarded with confusing financial noise. You open an app and see crypto hype. Your coworker gives you a hot stock tip, and there's this immense, paralyzing pressure to somehow find the next Apple or the next Nvidia before anyone else does. It's totally overwhelming, and frankly, it's designed to be. Okay, let's dive into this because the solution to all of this noise is incredibly straightforward. Section 1. Meet the index fund. Enter the actual hero of our explainer. We're not talking about a flashy new tech startup or some complex trading algorithm here. We're talking about the simple, proven, historical method that builds real, long-term wealth for the everyday person. So, let's break down exactly what an index fund is in plain English, totally skipping the Wall Street jargon. The gold standard we're focusing on today is the S&P 500. Just imagine a single shopping basket. Now, inside that basket, you place the 500 largest, most successful publicly traded companies in the United States. And that's it. When you buy an S&P 500 index fund, you're literally just buying that basket. You aren't guessing which individual company will win, you're just buying the entire arena. By purchasing just one single share of an S&P 500 index fund, and you might see ticker symbols like VOO or SPY for this, you instantly own a tiny fraction of Apple, Microsoft, Amazon, Tesla, and Berkshire Hathaway. You get this instant, incredible diversification across the entire U.S. economy. And you know what that does? It completely neutralizes the fear of a single company going bankrupt and wiping out your life savings. If one company stumbles, hey, the other 499 giants are right there to carry the weight. Now here is a really fascinating part, the self-cleansing mechanism. This is a brilliant feature most new investors completely miss. Index funds are automatically self-cleansing. When a company shrinks, fails, or just becomes obsolete, it literally gets kicked out of the index. And when a new tech giant rises to dominance, it automatically gets added right to the top of the basket. You, as the investor, never have to manually manage, research, or trade these companies. The index literally does all the heavy lifting for you. Section 2. The high cost of pros.
So you're probably thinking, if owning the whole market is so brilliant, why isn't everyone doing it? Well, that brings us to the real villains of wealth building, the hidden financial fees charged by active managers. Let's starkly contrast the costs here. When you hire a professional stock picker through an actively managed mutual fund, they typically charge you a 1% to 2% management fee every single year. I mean, they have to pay for those shiny offices and analysts somehow, right? But passive index funds, because they just automatically track the market without all that overhead, they often cost less than 0.05%. It is practically free. Now, a 1.5% difference might just sound like pennies, but let me show you the harsh reality.
Prepare yourself for this massive 30 to 40% figure. Let's say you invest $10,000 and just let it grow over 30 years. A seemingly tiny 1.5% annual fee from an active manager won't just take 1.5% of your total money. Oh no. Because of the loss of compound interest, meaning the fee money they took never got the chance to grow itself, that tiny fee actually devours 30 to 40% of your final portfolio value. That's insane. Wall Street gets paid whether they make you money or lose you money. Index funds keep that cash exactly where it belongs, in your account. But I know what you might be thinking right now. Sure, the fees are lower, but don't the professionals make up for it by picking better stocks? Section 3. The proof data. Let's move completely away from theory and look at the hard, historical data. And this brilliantly illustrates the reality of professional stock picking. We're looking at data from the SPIVA scorecards, which tracks S&P indices versus active managers. The numbers are totally undeniable.
Over a 15-year period, a staggering 85 to 92% of large-cap active fund managers actually underperform the basic S&P 500 index. Paying them those high fees literally results in you making less money than if you had just done nothing at all. Which brings us to a really fun, logical paradox. I want you to really process this for a second. If professionals who dedicate 80 hours a week to analyzing markets, holding deep dive meetings with CEOs, and running complex algorithms can't beat the index, what chance does a retail investor have trading individual stocks on a smartphone app during their lunch break? Seriously, a manager might get lucky for a year or two for sure, but thanks to market volatility, long-term consistency is statistically near impossible.
Section 4. Your worst enemy, emotion. So the math heavily favors the index fund, right? But the real reason everyday investors lose money isn't just fees. It's psychology. We are fundamentally hardwired to make terrible financial decisions. When the market crashes, think 2008, 2020, or 2022, retail investors let fear completely take over, and they panic sell at the absolute bottom. Then, when the market is booming, they get hit with massive FOMO, fear of missing out, and buy in at the absolute top. It's literally the exact opposite of what you should do. The index fund acts as a psychological shield. You stop betting on stressful individual stock charts, and you start betting systematically on the entire U.S. economy. It totally neutralizes overconfidence bias and that endless urge to tinker with your portfolio.
Section 5. The $1 million bet. To cement just how powerful this passive, emotionless strategy is, let's look at one of the most famous pieces of evidence in financial history. And it features none other than one of the wealthiest investors in the world. Back in 2007, billionaire Warren Buffett made a highly publicized wager. He bet $1 million of his own money that a boring, low-cost S&P 500 index fund would completely outperform a hand-picked group of elite hedge funds over a 10-year period. Keep in mind, these hedge funds were run by the so-called absolute best and brightest minds on Wall Street, utilizing their most aggressive, sophisticated strategies. The results of this 10-year bet are just staggering. By 2017, the completely passive, unmanaged S&P 500 index fund had returned over 7% annually. And those elite hedge funds, they averaged less than 3% per year. Buffett won the $1 million effortlessly and just donated it to charity. The lesson here is profound, guys. If Warren Buffett explicitly tells the public that a low-cost index fund is the absolute best investment for the average person, it is absolutely worth listening closely.
Section 6. Your superpower, dollar cost averaging.
So how do you actually execute this in the real world? How do you defeat market volatility without stressing out every single day? You use a specific strategy that I like to call your investing superpower. It's called dollar cost averaging, or DCA for short, and it's brilliantly simple. Step 1, pick a fixed amount you can easily afford, say $300. Step 2, invest it automatically every single month, no matter what the market is doing. Step 3, ignore the financial news entirely. Just tune it out. Here's why this is a true superpower. When the market drops, your $300 automatically buys more shares at a steep discount. When the market rises, you buy fewer shares. You completely remove the need to ever time the market because your average cost per share optimizes itself over time. It's genius. And there is a massive hidden advantage working in the background while you do this: tax efficiency. You see, active mutual funds are constantly buying and selling stocks internally, desperately trying to beat the market. In the US, this active trading triggers short-term capital gains taxes, creating taxable events that are passed right down to you, the investor. But index funds, they have incredibly low turnover rates. They rarely sell unless a company actually falls out of the top 500. This keeps your money growing tax-deferred, letting compound interest maximize itself without the IRS constantly taking a slice out of your pie.
Section 7. Start your wealth journey.
All right, we've shattered the myths, we've looked at the hard data, and we've established the winning strategy. You absolutely do not need to analyze balance sheets or be a math whiz to become a millionaire. You just need discipline, time, and the right vehicle. So here are your actionable next steps so you can start immediately. Look into opening an account with major, highly reputable brokerages. Companies like Vanguard, Fidelity, or Charles Schwab are fantastic places to start. Then you want to research broad market index funds. Look for ticker symbols like VOO, VFIX, or FXAIX. These are the tools that give you that instant, low-cost access to the greatest wealth-building engine in history. I really want to leave you with this core philosophy as your mentor today. Wealth building isn't about the thrill of timing the market. It's not about high excitement or gambling on the next hot trend. It is about staying perfectly boring, staying fiercely consistent, and letting the massive, undeniable power of the American economy do the heavy lifting for you. Time in the market will always, always beat timing the market. So I'll leave you with this final thought to chew on. Are you ready to stop playing Wall Street's outrageously expensive game? Are you ready to turn off the endless financial noise, set up your automatic investments, and finally let compound interest work its absolute magic for your future? The data is crystal clear, the path is simple, and honestly, the next step is entirely up to you. Thank you so much for joining me on this explainer, and hey, here's to your future wealth.